Good morning and welcome to today's webcast, Top Tax Strategies for California Businesses in 2018. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And I'm pleased to introduce today's presenters, John Clausen, Director, State and Local Tax, Curtis Miyaji, Senior Manager, State and Local Tax, and Roger Burggrabe, Senior Manager, Tangible Asset Incentive Services. And with that, John, I'll turn it over to you to get us started.
Thank you, Emily. Good morning, everybody. My name is John Clausen. I'm a director in the State and Local Tax Group, and today I'll be talking about the Cal Competes tax credit, and my colleagues will be talking about the partial sales and use tax exemption in California and the cost segregation opportunity. But before we get started, Emily, it looks like we're starting off with a polling question.
Yeah, our first polling question is: your company looking to expand within the next year, 2 to 3 years, 3 to 5 years, or other? And I'll give everyone a few moments to respond. To participate, please click the button next to the answer you choose and hit submit. And let's take a look at the results. John, back to you.
Okay, great. Thanks, Emily. So it looks like a lot of companies are planning to expand, and many in the next year. The first opportunity here is really focused on companies that are planning expansion, the California Competes tax credit. And the California Competes tax credit is definitely something to consider in the planning stage. You want to do it before you expand to apply for the credit. One of the requirements is that you apply before the expansion. Anything that happened prior to applying for the credit doesn't count. So it is important to get an application in before you start hiring and investing in California. The opportunity can be a great one for many companies, with credits ranging from smaller credits range from about $20,000 up to multi-million-dollar credits, sometimes as much as $10 million. I think there's been a few that have been even greater than that, up around $13 million. So the California Competes tax credit is an income tax credit. It's a non-refundable credit that is applied against companies' income taxes. It's basically available to all types of businesses. There are no geographic restrictions as there were with the former enterprise zone credits. There's no industry type restrictions. It's all businesses across the state in all geographies across the state. You must apply for the credit, and it is discretionary. The next application window opens up on March 5th, and it closes on March 26th. So it's approximately a 3-week period to apply for the credit. Up until midnight, I believe, you can submit your application on March 26th. And the amount of money the state is going to be giving away in March will be $55.4 million of credits. And of that amount, 25% of the amount given away will be reserved for small businesses that have annual revenues below $2 million, and that's measured by 2017 revenue. So it may be the case in your very first year of doing business that you have a small or no receipts, and that's actually a great situation to be in terms of applying for the credit, because you can fall within the small business category and have an advantage over other businesses in terms of being able to get the credit. But by no means do you have to be small. There's still a lot of money available for large businesses. And some very large businesses have obtained credits in the past. The key metrics considered by the state in awarding credits are employee growth and employee headcount planned over the next 5 years, and also capital expenditures such as investments in computers or larger machinery, basically anything that is capitalized for tax purposes with a useful life of more than 1 year. Also, leases count toward the investment side. So as stated, there's really no restriction on the type of business that can apply for the credit. And S corporations actually enjoy special treatment because there's 33% of whatever a credit award amount is given to an S corp is available to offset the entity level tax on S corps in California. So that's a 1.5% tax on S corp income. And then in addition to that, 100% of the credit award flows through to the shareholders in proportion to their ownership interest. So, for example, if the credit award was $300,000, then $100,000 would be available to offset entity level tax. And then in addition to that, $300,000 would flow through to the owners of the S corp. So it's really like a $400,000 benefit in the case of S corps. So here's an example of the type of credit that might be available to a business that has a modest amount of growth. Here we used a chocolate factory that's planning to build a $20 million facility, and they're planning to hire 9 technicians and 1 executive each year over the next 5 years. So that would be 50 people at an average salary of $100,000 per year, and they'll be investing $5 million in leases and computer equipment over the same period. And we've experienced helping applying for credits for our clients and have seen taxpayers with similar types of expansion plans be awarded credits greater than $700,000 for this type of expansion. Of course, as we said earlier, there's availability for even multi-million-dollar awards depending on how much you're planning to expand and also other factors, which I'll discuss soon. So here are some other facts, some various factors. These are straight from the GoBiz website of things that GoBiz considers when they're reviewing applications. The first two bullet points here are really the most important factors, which are the number of jobs that the business is planning to create or retain in the state, and then also the compensation that is planned to be paid to the new employees. The third one is probably the third most important factor, which is the amount of investment in equipment and other capital expenditures that the company plans to make over the next 5 years. And then there's a number of more subjective type factors that the state will consider, such as the level of poverty in the area that the company plans to expand, and also certain things might not work in a company's favor. For example, if a company had a lot of incentives already, but also if there were incentives being offered to the company from out of state, that could be something that would work in the company's favor. There are a number of factors, and another one that I don't think is listed here is that companies that might be planning to leave the state if they're not going to get an award, can state that in their application and increase their chances of getting a credit as well. A common consideration with our clients in terms of applying for the credit is a lot of clients are concerned about what type of information will be made public as part of this application. So we've created a slide that lists out all of the information that's made public in the application process. Basically, there's no personally identifying information other than there is one signature required by an officer of the company on the agreement that is made public. But in that agreement, the types of things that are listed there are the expected hiring of the company over the next 5 years, the expected compensation average over the next 5 years of the new hires. Basically, things that are anonymous but relate to the hiring plans and investment plans over the next 5 years. So the next steps are that companies should seriously consider applying in March for a California Competes credit if they are planning expansion over the next 5 years. And I will take time to mention at this point that a company that is currently experiencing losses and therefore not paying tax can actually defer the credit award out into the 5th year. So normally, for example, a $500,000 credit might be awarded evenly over 5 years or $100,000 a year. But if you're experiencing losses, you can actually ask for the state to defer the award until the 3rd, 4th, or 5th year, and that way you can increase the likelihood of your ability to utilize that credit in the future. And whatever doesn't get used in the year of the award is available to carry forward for 6 years after that. So it's quite possible that you could get all of your award in the 5th year, and then if you didn't utilize it in that 5th year, you could actually carry it forward 6 years after that. So it's potentially available 11 years out into the future or until 2029. So there really is ability to benefit even for companies that are currently experiencing losses. And additional tax savings opportunities might be identified as part of the process of the CalCompetes application, because you're going through the work of finding your planned investments and planned hiring. And so as part of that, you might identify opportunities to take advantage of the sales and use tax exemption for equipment, or to implement a cost segregation study of the useful lives of your property. And that's what my colleagues will be talking about here today. So Emily, we have another polling question.
All right, our second polling question: who is eligible to apply for the California Competes credit? Your options are only C corporations, only S corporations, only limited liability corporations, or any business qualified to do business in California. I'll give everyone a few moments to make a selection. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And this is our second question today. And let's take a look at the results. John, back to you.
Yeah, so we have a very sharp audience here. 93% got that right. So I'll introduce Curtis Miyaji. He's a senior manager with our state and local tax group at Moss Adams. And Curtis will be presenting on California's partial sales and use tax exemption.
Thank you very much, John. And hello, everybody. Today I'm going to be talking about the partial sales and use tax exemption opportunity. California has many exemptions for state sales and use tax. However, we're just going to focus on the partial exemption under Regulation 1525.4 today. This regulation was has been in effect since July 1st, 2014, and it does specifically relate to capital expenditures and also special purpose buildings, construction of special purpose buildings. So what is the tax savings opportunity? Well, the opportunity, savings for companies with manufacturing, R&D, or electrical power generation activities in California, the tax benefit is 3.9375% on qualified purchases, or I like to keep it simple and just say $39,000 of savings for every $1 million in capital spend. The good news is that the partial exemption has recently been extended to go through June 30th, 2030, with the passage of Assembly Bill 398 last year. So we're looking at an additional 12 years going forward in order to take advantage of this very generous credit. I want to also touch on or mention that there is a $200 million spend limit per calendar year per taxpayer on qualified purchases. So it is quite a very high dollar limit, and so there's a lot of opportunity there for companies, especially if they're planning a very large expansion. Also want to briefly touch on a related exemption under Regulation 1533.1, which is the tax savings on farm equipment and machinery, and that is currently 5% of qualified property by taxpayers who are primarily in the activity of producing, harvesting agricultural products, and raising livestock. Oftentimes, or sometimes, this exemption may go hand in hand with the partial exemption for manufacturing. So who's eligible? Most taxpayers that have activities in California meeting the definition of manufacturing, R&D, or electrical power generation can qualify for the partial exemption for purchases of capital assets and also construction of a new facility. The exemption can apply even if these aren't the company's main activities. And what we mean by that is providing that the company is conducting a qualified activity in some capacity, it can qualify for the partial exemption either as a legal entity or as an establishment of a legal entity. Examples include activities accounted for in a separate cost center, division, or physical location. So if a company has R&D activities, say in a separate division, that division, due to the qualified activity, can qualify for the partial sales tax savings. An example I like to use is, say, a university in California, like UCLA, whose main activity obviously is educational services. However, if they perform R&D services for third parties, they may qualify for the partial exemption on qualified purchases for that particular school or division of the university. Getting back to our example here that John talked about, we have a chocolate manufacturer, a factory, planning to spend $20 million on a new construction of a new facility. So they're going to hire a contractor to build this new facility in California. They also plan to purchase $5 million in machinery for this new facility. What are the benefits? Well, with the right planning and execution, the manufacturer's contractor can save 3.9375% in tax on the purchases of materials, and it is possible to pass that savings on to the manufacturer in the form of a discount of the contract price. The other direct benefit to the manufacturer would be savings of 3.9375% on the purchase or lease of qualified equipment for the new factory. So you've got a twofold benefit there. So what is the summary of the tax savings? Well, on the building, there's potential savings of about $393,750,000. And in this example, I'm taking 50% of the contract amount, or $10 million, which is a good estimate of the cost of materials that the contractor would purchase, again at the lower sales tax rate. On the equipment, the savings would be $196,975 for a grand total savings of about $590,000, close to $600,000 of savings on a $25 million expansion. Here are some of the considerations that one needs to take into account. We always advise beginning to think about how to take advantage of these benefits before making commitments to suppliers and general contractors. The earlier in the process, the better. Also, it's a good idea to review prior capital expenditures for potential credit or refund opportunities. Again, this regulation went into effect July 1st, 2014, and there is a statute of limitations in California of a 3-year look back. So it is possible, if a company has overpaid their sales or use tax, to go back to January 1st, 2015. Next steps. We recommend a company that's planning to expand, we recommend the preparation of feasibility study and a cost-benefit analysis to determine, one, if the company qualifies for the benefit, and two, to quantify the savings. We also recommend having a detailed game plan on how to obtain the tax savings, including monitoring the process periodically. And of course, the last bullet point, maintaining best practices in documenting the qualified activities, documenting qualified assets purchased. And this, of course, is for audit protection because there is the potential that the state of California may audit these transactions, and you want to be able to protect yourself in case of an audit. Emily, it looks like we've got a polling question here. I'm going to pass it on to you.
All right, thank you. Our third polling question, can taxes overpaid on qualifying assets be refunded to a qualified person? Yes, no, or I don't know. And I'll give everyone a few moments to make a selection. For those of you that would like a copy of today's slide deck, you can download them from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast. A couple more seconds here, and let's take a look at the results. Curtis, back to you.
We've got over 60% of the people say yes, and yes is the correct answer. It is possible to obtain credits or refunds on taxes overpaid on qualifying property. Again, going back to January 2015 is the statute of limitations. And I'm going to turn it over to my colleague Roger, who's going to talk about cost segregation.
All right. Thank you, Curtis. I'm Roger, and I'll be talking about cost segregation, the third and last tax strategy for companies to keep in mind today. The main idea of cost segregation is to front-load the depreciation benefit from buildings. And this additional depreciation can lower your tax liability in the immediate future, increasing your cash flow to help your company expand and invest. Without a cost seg study, buildings are usually depreciated over 39 or 27.5 years using the straight line method. With a cost seg study, we accelerate depreciation of buildings by identifying building components with 5, 7, and 15-year recovery periods. These short-life assets can qualify for bonus depreciation, which greatly increases the benefit for the taxpayer in year one of the building asset that it was placed in service. We'll talk more about bonus depreciation in a little bit. But just keep in mind, at the end of the day, the more short-life assets and expenses we find in a cost seg study, the sooner you can receive the benefit to lower your tax liability, creating a time value of money benefit. That's the idea that $1 in your pocket today is worth more than $1 in your pocket in the future. Who's eligible? I really only see the first bullet point as a real requirement, then the rest are just recommendations. Any taxpayer owning buildings or land improvements can potentially benefit from cost segregation. If you're adding or expanding your operations to your facilities, then you're a prime cost seg candidate. We look for buildings that are larger than $1 million because we know that they will have significant benefits, but that's just a preference. It's not really a requirement. Remodels over $500,000 are good candidates. That's because remodels typically have a large portion of personal property. We also look for taxpayers that have a current tax liability, but again, that's not a requirement, because for clients in an NOL, for example, the losses caused by cost segs can be rolled backward or forwards to other tax years that may have taxable income. Then taxpayers will need to consider if they plan to hold on to the building for 5 years or more to avoid any significant recapture concerns. This slide lists newly constructed buildings, building remodels, tenant improvements, and building purchases, all as viable cost seg candidates. The last bullet point says a look-back study. This means that we could do a cost seg on a building or improvement that was placed in service in a prior tax year by filing a Form 3115 accounting method change. I also want to mention the different types of facilities that are common. The different types of facilities include apartments, offices, retail, healthcare, industrial, and food processing facilities, among others. The recent tax reform was pretty favorable for real estate owners. A big change was in the bonus depreciation. As you can see in the first line, it goes from 50% to 100% for qualifying assets placed in service after September 27th, 2017. 100% bonus depreciation means you fully recover those qualifying assets all in the first year. So that can provide a huge benefit for taxpayers in year one of the building's life. In order to qualify for that 100% bonus, though, there can't be a contract in place before September 27th, 2017. If you do have a contract placed in, if you do have a contract in service before that September 27th date, then you kind of go back to the previous bonus rates. For example, 50% in 2017 or 40% in 2018. Okay. The next change to bonus is that the bonus period is extended a couple of years after 2019. Another significant favorable change with bonus is that it previously was only for certain new assets that met the original use requirement. Now it will be for both new and used assets. And this is a big advantage and it will significantly increase the cost seg benefit for building acquisitions. Okay. With that said, keep in mind that the state of California does not conform to bonus depreciation. So bonus will just be for federal purposes. One non-favorable change is that the tax reform does take away qualified leasehold improvement property, qualified restaurant property, and qualified retail improvement property. The remaining category we have left within 2018 is qualified improvement property, QIP, at 39 years. But it currently has no bonus as it's currently written. The last two changes for real estate owners, Section 179, the expense limit is increased to $1 million, and the phase-out starts at $2.5 million. Emily, it looks like we have a polling question.
Thank you. Our last polling question: can you perform a cost segregation study for a building placed in service in a prior year? Yes, no, or I don't know. And once you have completed all CPE requirements today, you will be able to download a PDF of your CPE certificate from the certification widget to the right of the slide view. I'll give everyone a few more moments to make a selection. And let's take a look at the results. Roger, back to you.
Okay. Yes, 85% answer their question correctly. You can do a cost seg on a building placed in service in a prior year. And then, we do an automatic accounting method change, and you'll have catch-up depreciation hit on the 41A. And so it could be a really good benefit. All that catch-up depreciation is hit in the current tax year. Okay. If we take a look at the chocolate factory example again, newly built ground-up facilities for food processing are excellent cost seg examples. The chocolate factory facility was going to cost $20 million with an additional $5 million in equipment. The cost seg study will mainly focus on the harder-to-find benefits of a $20 million facility, not really the $5 million in equipment. Those are already identified as equipment, so no benefit there with the cost seg. But if we think of a typical food processing facility, there's probably about 10% of the overall construction costs related to site improvements, such as asphalt paving for truck shipments coming in and out of the facility, and a large storm drainage system to help prevent flood damage. These two site improvement examples have a 15-year life and are 100% bonus eligible in 2018. If we think about typical features on the inside of a food processing facility, you can imagine a lot of conveyors, food processing equipment such as ovens and dryers, and then some packaging machines to make and ship the chocolate. A cost seg will add value in this scenario by qualifying the electrical and plumbing connections, the rough ends to those conveyors and ovens and dryers, and then this equipment can qualify as 5- and 7-year personal property. All of those connections and rough ends to those equipment can qualify as 5- and 7-year personal property. The personal property assets can easily be about 20% or more of the overall construction costs. So if we take the 10% and 15-year property and the 20% and personal property we found in the cost seg example, that's an additional $6 million in depreciation deduction taken in the first year because of the 100% bonus depreciation. The dark green line in the chart, that shows the additional cost seg depreciation in this example, and you can see the $6 million taken in year 1, and then it's pretty flat in the years 2 through 39. The $6 million in additional depreciation equates to about $2.2 million in deferred and federal and California state taxes in 2018. Things to consider with cost segregation, again, is that it creates a time value of money benefit. From the chocolate factory example, the $2.2 million in deferred taxes in year 1 gives about a $1.7 million net present value benefit over the life of the building. So I recommend, looking at depreciation schedules. You could seeing if you have any buildings in the prior tax years that we could do a cost seg benefit on. Some other fixed asset opportunities include disposition of property. That's if you do a remodel, you can write off the portion of the building that you remove. And then there's also some energy incentives. The Section 179D was recently extended for the 2017 tax year. That's the energy efficient commercial buildings deductions. That's where if you do an improvement to a building and you can qualify for up to about $1.80 per square foot, that's a federal tax deduction. And then if you think you have a cost seg opportunity, placed in service in the past, current, or a future tax year, I would say the next step is to consider a cost benefit estimate of a cost seg study. Here's the 3 tax tax strategies again, as with the chocolate factory example. When you look at the example savings here on the bottom, you can see that these are 3 good tax strategies to consider when you're expanding in California in 2018. The California Competes tax credit gave a $750,000 income tax savings. The partial sales and use tax exemption gave a $590,000 sales tax savings, and the COSEG study gave a $1.7 million net present value benefit. So those are 3 significant tax savings, tax strategies. The 3 main key takeaways from today. You should definitely consider applying for the Cal Competes credit if you're planning an increase in the workforce in the next 5 years. California has generous sales and use tax exemptions, about $39,000 for every $1 million for capital investments, buildings, and equipment. And lastly, if you have a new or purchased building, COSEG can significantly defer your tax liability and increase your cash flow now. Looks like we have some time for some questions and answers, Emily.
Great, thank you. We do have time for some Q&A. If you have a question for our presenters, please enter that in the Q&A box under the slides and click Submit. Or you may reach out directly to any of our presenters. We'll kick it off here with a question for John. If I don't apply for a Cal Competes credit in March, will there be another opportunity?
That is an excellent question. There may be an additional opportunity if the credit program is extended by the legislature. However, as of now, without any legislative action, the program will expire after March of this year. So we definitely are encouraging companies to take advantage of what might be the last opportunity to apply for the credit. And with that, I'll say that Moss Adams has helped over 50 companies apply for this credit. It's a service we offer. This isn't intended to be a sales presentation, but I do want to put a plug in for the firm to let everyone know that we can help apply for this service. We have a good success rate with our clients of over 75% success for the companies that we've helped apply for. But yes, the program may be extended. It's something that the governor put in his proposed budget plan, and we think that there's an excellent chance that it will be extended. However, it is going to require some action in order to be extended.
Thanks, John. Looks like we have another one for you. What happens if we don't hire as many people as we thought we were going to hire in the first year of the 5-year Cal Competes application period, but I hire them in the second year?
Thanks, Emily. So that's another good question. The credit, the ability to get the first year's credit doesn't go away entirely if you don't meet the projected hiring that you put in your application. So for example, if you said in years 1 through 5, I'm going to hire 10 people in each of those years, then you successfully got an award of, let's say, $500,000, and we're planning to receive that equally over the 5-year period. Then if you don't hire the 10 people in the first year that you thought you were going to hire, your ability to get that first year's $100,000 credit doesn't completely go away. It just carries over to the next year, and if you can meet that 10-person goal in year 2, then you'll get that first year credit. And if you get up to 20 by the end of year 2, you can get the year 1 and year 2 credit in year 2.
Great, thank you. And looks like a question for Roger. Can you do a cost seg on a building outside of California?
Yes, you can. Yeah, you could do a cost seg on a building in all 50 states in the U.S. and even overseas if you bring that income back to the U.S. So yes, it's not just for California, it's for anywhere, yes.
Thank you. And we have one for Curtis. What is the statute of limitations for sales or use tax credits?
That's a great question. It is 3 years, but it can be extended if one files a claim for refund. So it's 3 years from the due date of the particular quarterly or annual tax return.
Thank you. And it looks like we have another one for you. Can a distribution center in California have activities that may qualify for the partial exemption for manufacturing under CRTC Regulation 1525.4?
Wow, that's a good question. Yes, distribution centers can perform activities that can be considered a step in the manufacturing process. And packaging of product before it goes out to a customer can be considered a qualified activity. So there are opportunities for companies that have DCs in California. If they perform the qualified activities, there could be a very good benefit and savings in sales and use tax.
Thank you. And one for John. Can the Cal Competes tax credit be carried forward to a future year if not used in the year of the award?
Yes. The credit carryover period is 6 years. And because the credit is awarded over a 5-year period, you can defer receipt of the credit until the 5th year and potentially carry forward a credit 11 years into the future.
Thank you.
7 years from now, yeah.
All right, we still have some time here. Do acquisitions count towards or viewed as an expansion in the broad sense?
So for the Cal Competes credit, acquisitions are not counted as expansion. So if you acquire a company that has 100 employees, those 100 employees won't be treated as 100 new hires for purposes of the Cal Competes credit.
Okay. Does the March 2018 application window apply credits to the 2017 tax year? No,
the credit awarded in 2018 will first be available to be applied against 2018 tax.
Thank you. Let's see here. What kind of documentation would be required in the event of an audit if retroactively applying for the R&D tax credit?
Documentation such as the exemption certificates that the Department of Tax and Fees has available. These are Form 230M and 230MC, would need to be maintained by the qualified person. In addition to that, it's very likely that auditors are going to need to see proof of the use of the assets that are purchased and where the reduced sales tax rate has been paid. One of the requirements is that the assets have to have a life of 12 months or longer. In addition to that, they must be primarily used in the qualifying activity, primarily being 50% or more of the use has to be in either manufacturing, R&D, or electrical power generation. So one would have to point to the accounting records to prove to the state that, yes, indeed, the assets are accounted for in a particular division or establishment and that they're used substantially, again, in the qualifying activity. And the only way to do that is to point to the accounting records and the internal cost accounting records.
Thank you. How about, does the equipment have to be purchased from a California supplier to be eligible for the R&D sales tax credit?
Good question. No, either California supplier or out of California suppliers, it doesn't really matter. If the supplier is not registered to collect California tax, then the qualified person will need to self-assess and report the reduced California use tax on their sales and use tax tax return. So the answer is no. Either in-state vendor or out-of-state vendor, it doesn't matter.
Okay. Is the annual filing of California sales tax more complex because of the R&D sales tax credit? For example, no more short form?
It shouldn't really matter because if you're buying from a supplier or vendor that is collecting California taxes, they will just collect the lower rate. And so it would have really nothing to do with filing of a short form or a long form. However, if you're purchasing from suppliers that do not collect California tax, then it could affect the filing. You may have to file the longer form because you will need to report use tax on line 2 of the sales and use tax return. So the answer is yes if you're buying from out-of-state suppliers. No, there should be no effect if you're buying from in-state suppliers.
Great, thank you. I think it's mostly good for a new startup company if you open business in California. Am I correct?
No, actually, many established businesses have received California Competes credits. The full list of awardees of the credit is available on the GoBiz website. But as long as you're expanding your headcount in California over the next 5 years, you're a good candidate for the credit. So you don't have to be a startup or a small business. If you are a small business, you have a slight advantage because the state reserves a portion of the credits that it's giving away to that group. But really, any business expanding is eligible, and some bigger names that have received credits are Samsung and Tesla, Macy's, Nordstrom's. So there are some large, well-established companies that have successfully applied for credits, in addition to many, many smaller businesses.
Thank you. How can you ensure that your industry class qualifies for the R&D sales tax credit? For example, if you design ASIC but don't actually manufacture them, do you still qualify?
So in Regulation 1525.4, there is a list of industry codes, or it's also known as the NAICS codes, which will list out companies, particularly industries. If you're performing R&D services in California and you're purchasing qualified assets, there is the opportunity to be able to pay the lower sales tax rate if you're doing R&D activities, even though you're not manufacturing here in California. It all depends upon the cost benefit.
Great, thank you. If retroactively going for the R&D sales tax credit, do you still have to file an exemption certificate with the past supplier?
That's an excellent question. Yes, you would need to file a partial exemption certificate with that supplier. You would also need to ask the supplier to refund you any taxes that you had paid that were over the exemption amount. So it's likely that that supplier will need to file a claim for refund or amend their sales tax returns and then issue the qualified person either a credit memo or a refund of the tax over-collected.
Thank you. Can equipment leasing companies get these credits as well?
So I'm assuming that's referring to the CalCompetes credit, and yes, really any business, any industry type is eligible to apply for the credit. So we can help any company that wants to apply for the credit to apply for the credit. There's no restriction on who can apply.
As it applies to the sales and use tax side, leasing companies may receive partial exemption certificates from customers who are leasing equipment either for manufacturing, R&D, or power generation. And in that case, they would lower the California use tax on their lease payments in accordance with the regulation. In other words, the credit would be 3.9375% less sales tax, or use tax on the lease payments. So their customers would benefit because they would pay a lower tax rate.
Great, thank you. I think we've addressed most of the questions that have come in. So I'm going to go ahead and close this out. If you think of any other questions for our presenters, feel free to reach out to them directly. And thank you, John, Curtis, and Roger, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.